Mondelez International, stock ticker MDLZ, is trading right at $56.96 per share, which actually puts it at its 52-week low. And we can see over the past year, this company is now down over 23%. And like most companies, when they're trading at their 52-week low, it gives them a much higher starting dividend yield than normal. Look at this. This is now the highest starting dividend yield they've had in over 5 years. And if we zoom out and look at the past 10 years, the same is true. The highest starting dividend yield in over a decade. Now, we don't typically think of Mondelez as a high-yielding stock. We think of it more as a dividend growth stock. For example, if we jump over to my dividend breakdown sheet, come over here and plug in MDLZ. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, you can head over to tickerdata.com at the link in the description. But again, yes, starting dividend yield around 3.3%. But look at the dividend growth that this company's seen. The 10-year dividend CAGR at 12.5%, the 5-year at 11.52%. So they've been growing their dividend at a very high rate. Now, there's plenty that we need to touch on about the company. Why are they at the 52-week low? What's going to go on with their future earnings report? What are the headwinds they're going into? And are they undervalued? So let's go ahead and jump into it. Now, if you aren't familiar with Mondelez, this is a consumer packaged goods company, or in other words, basically a snack company. We can see they're market leaders for things like chocolate, biscuits, cake and pastries, and snack bars. And if we look at the 6th slide on their investors presentation, we can see they're the 2nd largest global chocolate manufacturer. And on the 8th slide, you'll probably recognize a lot of their most famous brands, such as Oreo, Ritz, Cliff Bar. So this is obviously a very well-known brand. And if we scroll down to the 9th slide, here's the good news. There's still plenty of room for growth, especially in emerging markets. Look at this, organic net revenue CAGR, 13.9% in the emerging market area. Now, anytime we want to analyze a company and decide if it's worth investing into, we have to make sure it aligns with our goals. And the way we can do that is by looking into their capital allocation priorities. So if we jump all the way over to the 22nd slide, we can start to get an idea of what their priorities are when it comes to capital allocation. Now, for almost everyone, the main priority for any company you invest in should be for that company to reinvest capital back into the business to continue to grow. And for example, if we jump back over to the dividend breakdown sheet, what we can see is the free cash flow payout ratio for Mondelez is sitting at about 60%. So 60% of their free cash flow is currently being used to pay out dividends, leaving 40% of their free cash flow left to do things like reinvest back into the business or buy back shares or even pay down debt. So let's look at this again. Top priority, reinvesting back into the business. They're also exploring mergers and acquisitions, but then they talk about not just dividends, but total shareholder return. What does this mean? Well, we already know, yes, they not only have an attractive starting dividend yield and dividend growth, but they also buy back shares. Again, shareholder yield is buying back shares and also paying out a dividend. So for example, jump over to our stock screener, come up here and plug in Mondelez. And what we can see is when we come down here and look at shares outstanding, they've actually bought back quite a few shares over the past decade. So let's put things into perspective. If we look at Bogle's valuation, again, we want to look at the shareholder yield, dividend yield plus buyback yield. What capital are they using to reward us as a shareholder? And we can see over the past 5 years, the average buyback yield is about 1.53%. So if we add that on to the current dividend yield, the shareholder yield is about 4.83%. So that's a pretty good return on your capital if you're buying into this company. They're rewarding shareholders with their capital. Now, if we jump back over to the investor's presentation, jump over to the 25th slide, there's one more thing we have to point out. They not only buy back shares, but it says opportunistic share repurchase. What does that mean and why is that important? Well, when it comes to buying back shares, this is really only valuable to shareholders if a company is buying back shares when the stock is undervalued. If they're doing it when the stock is overvalued, it can actually destroy shareholder value. And like we've already mentioned, the company is currently trading right at its 52-week low. But here's what's really interesting about this. Look at what the company announced just about a month ago. Mondelez approved a $9 billion share repurchase authorization program. So they're ramping up share buybacks during a time period where their stock is much lower than it typically trades. So this falls exactly in line with what they're telling us in their investor presentation. They're looking for opportunistic share repurchases in order to get the most out of their capital, the most out of their share buybacks. They ramp up the share repurchase program when the stock appears to be undervalued. And that's exactly what they're doing right now. And if you buy this stock, it will provide even more value to you as a shareholder. So far, there's a lot to like about the company. They're a leader in their industry. They're trading at a 52-week low. The dividend metrics look good. The buyback program looks good. So what's going on? Why are they trading at a 52-week low? And the main reason that we can point to is the commodity market. Cocoa prices are absolutely skyrocketing right now. To put things into perspective, this is a price chart of cocoa over the past 5 years. We can see pretty stable for quite some time, and then 2023, early 2024 hits, and it absolutely skyrockets at more than 4x's in price. So how has this impacted Mondelez? Well, if we jump over to my profitability sheet, I've already plugged in Mondelez. If we look at the gross profit ratio over the past decade, it's actually relatively stable. We can see last year's gross profit ratio at 38.2 with a 10-year average at about 38.5, so not too much of a change. But let's look at 2024. What's been going on so far? Keep in mind they haven't reported full 2024 data yet, but let's look at the past few quarters. Again, we have last year's gross profit ratio at 38.2. Let's look and see what happened in the most recent quarter using the ticker data function. We'll select Mondelez, select gross profit ratio 2024 and Q3 and hit enter. And we can see last quarter, the gross profit ratio was 32.58%, significantly lower than last year's gross profit ratio. But what happened in Q2? Let's check that one out as well. We'll plug that in. We can see it was even lower, just at about 30%. So the margins are starting to see are significantly lower than what they're used to. This is a major headwind for the company. And so while it's not likely that this headwind will last forever, this problem is definitely going to show up in the earnings report for this company. For example, let's jump back over to Seeking Alpha. They have an earnings report coming up next month. Look here, the earnings per share revisions over the last 90 days. We have 18 analysts with bearish revisions and 0 with bullish revisions. So there's not exactly high expectations for the next earnings report. But with that being said, does that create opportunity? If we look at earnings estimates for the company moving forward, we can still see, yes, there is a little bit of a headwind, but overall we're still looking at upper single-digit earnings growth, which is pretty solid for a company like Mondelez. So is this company undervalued? To answer that question, let's jump over to my stock valuation spreadsheet, again available on ticker data, but we'll plug in the ticker and hit enter. And again, all this data will load in. Now, before we look at the first valuation, I do want to point out, look at the beta for this company, sitting at just 0.56. So you should see low levels of volatility with this company, which is attractive to a lot of dividend investors specifically. Now, if we go and jump over to our first valuation, we're going to start with our discounted cash flow analysis. Again, we're valuing the company based on how much free cash flow they're projected to produce in the future. And in this scenario, we're assuming a free cash flow growth rate of about 7% for Mondelez. So we apply that growth rate to the future free cash flows, find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, subtract out total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of just around $46, which is actually lower than the current share price. But let's keep moving forward. Let's look at the historical multiple valuation. What we're doing is we're looking at how the company has historically been valued compared to how it's valued right now. And what we can see is the average PE ratio for this company over the last decade is close to 26.8. But for the trailing 12 months, it's about 19.99. So compared to how they've historically traded, they look about 25% undervalued. So that's interesting. We see a pretty big difference in the historical multiples valuation versus the DCF model. Let's keep moving forward. If we look at our multiples comparable valuation model, what we're doing is, again, we're using multiples to value this company, but we're comparing it to how other companies are being valued in the market. So we have companies like Hershey, like Nestle. We can see their price to earnings multiple both sitting right at about 17 to 17.5. The average is 17.35. So if we applied that same multiple to Mondelez, we get an intrinsic value of about $63.15, which once again is actually pretty close to the current share price, but it's a little bit above. So let's look at one more valuation, our dividend discount model. And again, this is going to value a company based on how much they pay out in dividends and how much that dividend is increasing over time. And like we've already seen, the dividend growth history for this company is actually pretty decent. And the 5-year free cash flow CAGR is sitting close to about 5%. That should be even higher moving forward as their earnings expectations have increased, which again will allow them to increase their dividend payouts over time. So assuming a dividend growth rate of about 6% and a discount rate of 8.5%, we actually come to a pretty high dividend discount model price per share of $79.71, quite a bit higher than that current price. So if we look at the output tab, let's take a look at all the valuations that we used. Again, we don't have the historical multiples valuation on here because it doesn't give us a specific buy point, but it did find that the company was undervalued. But if we average these three valuations together, we come to an intrinsic value of about $62.90, and the current share price is sitting at $56.96. So what does this tell us? Well, the company is currently about 9.45% undervalued. But again, we always want to apply a margin of safety. So with a 10% margin of safety, it looks like our acceptable buy price is about $56.61. So not quite in that buy range, but getting very close. With a 20% margin of safety, we're looking at an acceptable buy price of about $50.32. So I do think Mondelez is one of the more interesting situations on the market right now. I think there's a lot that the company is doing right, specifically with their share buyback program, but the company is also very reliant on the commodity market. It is a weakness for the company that they're pretty much completely reliant on how the commodity market is moving. Margins and earnings expectations aren't looking too good for the next few quarters. But the good news is, if this is a short-term headwind, I do think it creates opportunity. But if this problem continues to drag out, it won't be a good sign for the company. But go ahead and let me know what you think of Mondelez International in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.